Hi CA students, let's revise CA final AFM chapter 6 portfolio management practical question 26. Your client is holding the following securities. A list of securities equity shares are given wherein the cost, dividend and market price is given along with the beta of the respective shares. Average return of the portfolio is 15.7, so which is nothing but the expected return of the portfolio is given 15.7%. Calculate expected rate of return in each case using the in each security using the CAPM approach. So CAPM we know it is nothing but the expected return under CAPM equal to risk-free return plus beta into risk on market return minus the risk-free return. Here RF signifies the risk-free return and beta multiplied by RM minus RF. Especially this RM minus RF is nothing but the market risk premium, market risk premium, yes, market risk premium. Okay, now using this there are multiple ways of doing it. ICAI also given 2-3 methods. One approach is finding out the individual return of the stocks and then taking the average. So if we go with that individual return, so individual CAPM will be finding out, right? So we just need the components here, and we know that the average return of portfolio, which is nothing but the expected return, is 15.7, and risk-free return we need to calculate, and risk premium, market return we have to calculate, risk on market return also. Now risk-free return can be found out by one thing, as we know that GOI bonds or the government bonds, government of India bonds, which will be a risk-free security. So we can keep that as the base for risk-free return. And even as we can notice that even the beta is so negligible, 0.01. This is because a risk-free return will not, risk-free return on a GOI bond, it will not have any risk itself, even the market risks, as it will be backed by the government or some or the other way underlying, right, like that. So beta is 0.01, so we can keep this as the risk-free security. Now whatever return we are getting on this will be the risk-free rate also, return also. Now so we can, there are 2-3 approaches here. They have followed this also. 34,000 minus, so 34,500 minus this 36,000 will give us the capital appreciation, then plus dividend 3,600 divided by the cost, which is nothing but 36,000, will give us the risk-free return. This is one way of doing it. The other way is, we know the average return is 15.7, right? So the expected market return they have calculated by 16.7, so which is nothing but the securities which they have given. No? They have individually calculated the capital gain, dividend and then cost, then they found out the expected return of the market rate. They use that as the base for return on market portfolio. So we will get the CAPM for each and every return. So that is the conclusion of this question. And finally, this is this is a different approach. So from here it is getting separated. We can follow any approach if we are just confident with the concept, then anything is fine.